And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning, welcome to the show. Of course, it's Tuesday as we get this week underway. Yesterday, markets had a little bit of a recovery rally. Of course, we're still in this correctional process. We'll talk some more about that in a moment. No real economic data today to speak of. Actually, none yesterday either. Earnings, still kind of just finishing up for the last quarter. A couple of companies out today. Of course, meme stock fame today. GameStop reports today. So we'll see how the company does based on its earnings and revenue. Because again, people. They're still buying video games and those type of things, but, can it live up to the hype of what a lot of the meme stock traders have hoped for in the past? Of course, remember, if you don't remember, GameStop was, actually there's a whole movie out about it right now, about the whole, kind of the retail trade on GameStop a couple of years ago. So again, they report earnings today. It'll be interesting to see how that turns out. We have inflation tomorrow, though. That's going to be one of the bigger reports this week as we kind of start moving closer and closer to the next Fed meeting. The big expectation right now by the markets is a 25 basis point cut by the Fed this meeting, but 225 basis points altogether by the Fed before the end of 2025. So that's a pretty big drop. We're 5.25%, roughly 5.3% on the effective funds Fed funds rate right now. So if you subtract out, half of that, that's what the market's expecting. They're expecting Fed funds to be down around 2.5%, 2.25% by next year. So again, fairly drastic drops, and of course we're starting to already see this reflected in like the 2-year Treasury. That's a good leading indicator of where Fed funds are going to be. 2-year Treasury yields have been dropping fairly sharply here, along with much of the short end of the curve in anticipation of those Fed rate cuts. We're seeing those rates starting to come down now. So again, the 2-year Treasury is a really good proxy for the Fed funds rate. There's a very close correlation, but the market, since the market is going to kind of project or kind of anticipate what the Fed's going to do, the 2-year Treasury leads the Fed funds rate by a small margin. So those yields are declining. That's kind of really building a lot of confidence the Fed will be cutting rates starting this month and then continuing that through 2025. Outside of that, though, the only real kind of interesting item going on with the markets at the moment is earnings, which forward earnings revisions continue to get ratcheted down here. Now, again, you have to remember that markets trade off of earnings ultimately. And, so all these other stories and narratives out there, you can throw a lot of those away. Really what the markets are paying attention to more than anything else, there's a very high correlation between asset prices and earnings. And those earnings estimates are starting to decline now. They were very exuberant earlier this year. They've been tailored off all this year so far. There's been a very slow decline in those. Those have been picking up steam here a little bit lately as some of this economic data comes in weaker than expected, particularly following the jobs report we just had. So we're seeing those earnings estimates come down. That, of course, as we stated before, that sets the whole the millennial earnings season up for October so that we can beat lowered estimates. But that's why we do this. But going into next year, estimates are still high, but those are coming down now as well. So we're starting to see a lot of the estimates being ratcheted down as the reality of weaker economic growth is showing up. Now that'll have an impact on markets going forward because ultimately, again, it's about earnings. And so if earnings don't meet those expectations, that is going to impair the markets to some degree because markets have to reprice for future earnings. So if those earnings are coming down and investors say, well, I was going to get $10 a share, now I'm going to get $9, I got to reprice a bit. So again, that's going to potentially weigh on upside in the markets. And if we start to see a real deterioration in earnings over the course of the next couple of quarters as we get into next year, that's going to certainly impair prices further as markets begin to reevaluate fantasy for reality in the markets. Okay, let's talk a little bit about what you need to know before the bell this morning, because yesterday we got a little bit of a rally, and it was kind of a disappointing rally, just so to speak. We started off, had a nice rally, then kind of gave up about half of it by the end of the day. But the markets did end on a positive note, so that's good. Secondly, we kind of bounced off that 100-day moving average. That's good. And we were oversold on a relative strength basis and bounced off of that. So that's good. So we had a decent, kind of a bounce, an initial test of support at the 100-day moving average. Clearly not out of the woods yet. For the markets in general. Still on a MACD sell signal here, so again, that suggests that we're going to have weaker prices ahead. Again, doesn't mean the markets have to decline a lot, but ultimately it's going to really kind of suppress any type of upward action in the markets for right now until we kind of work that signal off and get back to a buy signal wherever that occurs. It's going to be hard for markets to make a lot of advance. This morning, futures are about flat for the open. So again, what we need to see here, yesterday the market rallied kind of right into the 50-day moving average, failed there. So we had an initial failure at that 50-day moving average resistance. We'll see what happens today, but the market needs to make sure and hold on to support here at the 100-day moving average. If we take that out, we're going to be looking at the August lows, which are also kind of in a line right now with the 200-day moving average. So there is definitely some risk to the downside. And when we come back from the break in a minute, we'll go through kind of our article on the website today, which is talking about kind of the 3 bullish and 3 bearish narratives of the overall market as we kind of go forward into this year. But the important thing there is, this is still clearly in a position to where we are managing risk right now more than trying to gain exposure to the markets. We have a lower high that was set here just recently. So again, that is also providing another level of resistance. We're going to have some pretty important tests here if markets try to rally, particularly at this double top in the market. So again, on the upside, there's a lot of barriers of resistance for this market to travel higher between now and really the end of the year. Now, I'm not saying it can't do that. I'm just saying that there's going to be a lot of resistance here as markets try to rally. And particularly right now, if we start taking out important levels of support, there's kind of big gaps between where we're currently trading and next big levels of support. So markets can kind of unwind here pretty quickly. And again, this is why we've talked about before, manage some risk, raise some cash, kind of rebalance positions right now. Those are the kind of those easy actions to take to lower your overall portfolio volatility. Unfortunately, we haven't got a decent setup in bonds yet to add bond, to increase bond exposure in portfolios. Those issues still remain very overbought right now. The 20-year Treasury bond (TLT), as an example, is pushing up right on new highs at the moment. We've got a very big move here. We're on a buy signal, so again, what's happening with bonds right now is very positive. And again, we've had a very, very long rally in bonds here for the last several months. Really, ever since the beginning of the year, we've had a very strong rally in bonds all across the board. But again, they're getting overbought on a short-term basis. Even they've got a buy signal at a fairly high level, and again, they're pretty extended from moving averages. So again, it's difficult to add bonds to a portfolio right now. So if you own them, great, hold on to them. If you're trading them, good place to maybe take some profits. But really difficult to try to add bonds to your portfolio right now. You need some type of pullback, probably to around 95 to 98. On TLT as an example, to get a better entry point to add bonds to the portfolio. And so we'll be keeping a watch on this, and of course, how we get there. But again, kind of watch the market. We're kind of in that tenuous spot right now. Manage risk. That's what's more important. Cash is a good hedge at the moment, and we'll talk some more about that when we come back from the break as well. But that's what you need to know before the bell this morning. When we do come back, we'll talk about 5 actions you can take in your portfolio right now to hedge risk. We'll talk about some of the bullish and bearish setup for the markets as well. Also, we got John Penn here today. Lots of stuff to talk about, so don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Yeah, James in our chat reminded me that yesterday Palantir and Dell also got kind of moved higher in yesterday's market as they are getting added to the S&P 500 index. If you want to know what happens to stocks once they get added to the S&P 500 index, go look at SCMI, the microcomputer company, super microcomputers. Yeah, that stock's down about 80%, 60, 70% since it got added to the S&P. So typically they kind of get, stocks kind of get added to the S&P kind of at the peak of their momentum. So just be a little, be careful chasing stocks when they get added. It's always kind of better to wait till after they're added. They tend to correct. Actually, there's a lot of analysis that says this: you should short the stocks that get added to the S&P and buy the stocks that get taken out of the S&P. There's a good bit of analysis that goes back on that shows that that's actually a decent trade setup to do that.
Are we incorporating that in our portfolio?
No,
okay.
we're not. But
just putting that out there.
Yeah. No, but it is interesting. It's just it seems like for S&P who are building the index. But this really comes back to a really good important point about the S&P and the index and trying to benchmark your performance to the index as well. And this is a great reminder of that, is that the index is not real. There's not real money in that index. It's just pick a stock and you put it onto a spreadsheet and you base it on market capitalization. However, when you're trying to build your portfolio to replicate the S&P 500, you have to actually invest your capital in those stocks. So as a good example, let's just, a good example is General Motors back in 2007, 2008. You own GM in 2002, 3, 4, it's doing great. And then they basically get on the verge of bankruptcy and stock loses a tremendous amount of its value and is taken out of the S&P 500. That's great. Well, the problem is that you have real dollars invested in that. For the index, all they do on their spreadsheet is remove GM, and I can't remember who they stuck in now, but they insert the new company in and rebalance the index for the new market cap of the new company. Now, that's called substitution. But you can't do that. You had $1,000 invested in General Motors in your portfolio. You were market weight the index for General Motors. That $1,000 is worth now, $80, whatever it was. Well, you've only got $80 to buy the new stock with. You don't have $1,000. You've got to go reach in your pocket and pull in a new $1,000 to buy the new position that's getting substituted, right? Then you got to rebalance that to the new weight. But that's why investors historically never track the index over time. There's so many, and mutual funds and everybody else. Anybody investing real capital into an index cannot track an index because indexes aren't real. They have no taxes, they have no expenses, they have no withdrawals, they have the ability to do substitutions, all those type of things. They're affected by buybacks. Your portfolio isn't affected by buybacks, but the index is, because it's all based on market capitalization. So always remember that there is a big difference between your portfolio and the index. And again, the reason that Wall Street, we've talked about this before, but the reason that Wall Street wants you to compare to an index is to keep you perpetually upset so that you will continue to move money around. You move from Merrill to Schwab, from Schwab to Fidelity, from Fidelity to Pershing, from Pershing to somewhere else, because you're just, you're trying to find a new advisor because your last advisor didn't keep up with the index, so now you need a new advisor, or you're just, moving your money because you're mad at the old brokerage firm, and that's great, right? Not for you. It's great for the brokerage firms. It's great for Wall Street because, again, every time you move money, it's all new trades, it's all new revenue, it's all new fees. So again, money in motion creates fees, but this is the problem with tracking indexes over time and why you should grossly avoid it. And yes, S&P regularly swaps out stocks, but again, if you go buy Palantir today because it's going into the S&P 500, just know that you're really paying for an overvalued stock that's also technically very extended right now. So.
Yeah, I know I've said this before too, but I think as investors, I think the media has done a great job, Lance, of training us all to compare our own returns to that of the Standard & Poor's 500 index or the NASDAQ or small caps, whatever that may be. And, I can't tell you how many times I've had conversations with folks where, the conversations start off and say, hey, I'm at a point in my life, John, where I don't really think I need to take a lot of risk here. I've kind of won the race. I just want my money to grow, participate, fight inflation, keep my purchasing power, and do the things that I want to do. Okay, well, so let's set up a portfolio strategy here. Let's manage the risk appropriately so you can continue to live your lifestyle. And then all of a sudden, the market's up 15%. It's like, well, hold on. Well, why am I not up 15%? Well, you don't have 100% of your portfolio in stocks. You don't need to have 100% of your portfolio in stocks. You have 35, maybe 40, maybe 45-ish% of your money in equities. So guess what? You're not going to get all the upside with that. But at the same time, if markets get volatile, if we get into a more, volatile market environment, if the market's down 15%, now all of a sudden, hey, your portfolio looks pretty good, right? See, it's you got to kind of take that all in check a little bit, right?
No, that's right. And this is, kind of the issue we talk about. A couple of questions in chat, coming around this is, well, what if you just buy the S&P index? Guess what? Here's a dirty little secret that Wall Street won't tell you. You're still going to underperform. If you take a look at the S&P 500 and take a look at the Vanguard S&P 500 ETF, you underperform the S&P index on a performance basis. Why? Because you pay a fee for the ETF. Somebody's got to make money, right? There's nothing for free. So the fees eat into your performance. You'll be close. Now, mind you, you're going to be very close to the return of the S&P, right? But you're still paying a fee. And then, of course, if you take withdrawals or if you're in that phase of life where you need, money for whatever reason, anything that you do to your account other than just leave it alone is going to impair that performance even further. But even if you just put $1,000 into the Vanguard S&P 500 index over time, now it won't show up immediately, right? But over time, over a period of 5 years, 10 years, whatever, however long you're going to hold it for, you're going to underperform because of that annual fee that's getting charged by the ETF. because, again, there's no free lunch. And then any other fees that come along, taxes, anything else you owe. And if Kamala gets her way and we're taxing capital gains, you're going to really underperform the S&P. Because
that haven't even been realized yet.
Yeah, but you're going to get taxed on it, but the S&P index doesn't. So now performance gaps are going to become huge because of tax. And look, that's not going to really happen, but I'm just saying, if you do something like tax unrealized gains or anything like that, you're going to really have vast underperformance because of that tax that the index doesn't pay.
Agree.
So.
So you're right. There's no such thing as a free with exchange traded funds, even, for folks that have money in their money market funds right now. John, I've been enjoying, close to 5% yields and I'm not paying anything for it. Yeah, you are. There's an embedded fee in those exchange traded funds that you're using. There's an embedded fee in that money market fund that you have your money in right now. It's just that you don't see the fee. It doesn't show up as an actual debit or an expense on line itemed out on your statement. So there are costs in there that you have to be considerate of, right? Think about.
Yeah, that's right. Real quick, before we hit the break, Brent, can you bring this chart up for me? So in today's article on the website, I do this exercise for myself every week, but I decided to write about it this week, which is I gave you 3 charts, 3 bullish points, 3 bearish points about the market. And the whole purpose of that exercise is to battle confirmation bias. And so, but one of the charts in particular kind of jumped out at me, which was we do this weekly analysis in the newsletter, and particularly on our 401k retirement plan page, that looks at a weekly performance index of the markets. And those two charts at the bottom, those are weekly MACD indicators. One is an intermediate term, one is a very long-term MACD indicator. The important thing about that is that when both of those signals register sell signals, now we're not there yet, right? We're very close, but when both of those register solid sell signals and confirm sell signals, you've typically had bigger corrections in the market. Last time we were at these levels and confirmed a sell signal was at the peak of the market in January of 2022. And of course, we had about a 20% correction that year. So, we're right at the top of this long-term uptrend. We're very overbought. Now, again, this is weekly, so this is long-term. In the short term, markets are getting pretty oversold here and are due for a bounce. So again, the markets can bounce here, but on a longer-term basis, we're certainly kind of looking at a setup where there is potentially more risk to the downside. Now, the conclusion of this article is basically kind of 5 steps to go through to rebalance and kind of manage risk in your portfolio. Trim your winning positions or, back. Make sure you're not taking a lot of speculative bets in your portfolio, but trim, if you've done that, take some gains, rebalance those back to wait, sell the positions that aren't working. You bought a stock, it's just not doing what you thought it was going to do. If it didn't perform on the rally in August, it's not going to perform. It'll perform worse during the decline. So, be careful of that. Move your trailing stop losses up to current levels where they should be, recent moving averages, etc. But move your stop losses up now. Review your allocation. Make sure it's in line with your risk tolerance. It's easy for portfolios to drift during bull markets like we've had over the last 2 years. We start getting kind of more aggressive in our holdings because, markets are doing well. It doesn't seem to be real big downside risk. So kind of revisit that allocation relative to your risk tolerance. And most importantly, raise some cash. And, cash never hurts to hedge risk in a portfolio, particularly, moving into the election. But, if we start triggering these kind of weekly sell signals, it's going to suggest that markets are going to struggle a bit. So having a little bit of extra cash will certainly help out. That article on the website now, realinvestmentadvice.com. Today's article on kind of the 3 bullish and 3 bearish views of the market. So all there for you. realinvestmentadvice.com. We'll be back. Pick up with John Penn. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I remember in school those history stories about the late 1800s, and now Gen Z kids are now calling the 90s the late 1900s.
The Real Investment Show podcast.
And I feel like I just drank from the wrong grail in Indiana Jones.
Same show, your schedule.
I was talking to my daughter a few weeks ago, and I said something that she didn't agree with, and she goes, "Dad, you're just getting old and not relevant anymore."
At realinvestmentadvice.com.
Not relevant.
You're not relevant.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Denny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So, wanted to do a little bit of a conversation this morning with John. We had a very interesting prospect email come in this past week. And, you know, kind of a young guy, 41 years old, and doing very well for himself, earning a lot of money right now. He's got a very well-paying job, doing all the right things, saving a lot of money. And, you know, wants to, you know, create a portfolio to generate income, which is kind of everybody's goal. And just as an example, there's what we call realistic expectations and unrealistic expectations. And just as a good example, yesterday I got an email asking, says, hey, you know, I'd like you to manage some money for me, and I would just like you to create a dividend of, you know, 8% or more every year. And I'm like, hey, I'm not your guy. Now, a lot of financial advisors say, sure, yeah, no problem, give me your money, right? Now, they know that they can't generate an 8% dividend. Now, we're talking about a dividend. We're not talking about return, just a dividend, income every year. And yes, I could certainly generate 8%. I can go scan for stocks that all yield 8% or better, and there's certainly some out there right now. But they have a very bad habit of losing a tremendous amount of their value at certain times. So again, it's not a realistic. When the S&P yields less than 2%, and you're asking for roughly 4 times the yield of the S&P, that's not really realistic. Now, again, can you create it above S&P dividend? Absolutely, right? Our dividend equity model yields near 4%. So, but that's reasonable and doable. And again, there was a comment about intrinsic value versus technical analysis on companies. And so, yeah, when you're building a portfolio, fundamental analysis, and particularly when it comes to dividend investing, fundamental analysis is extremely important. Looking at free cash flow yields, PEG ratios, those type of things, those are very important as to the sustainability of a company to be able to continue to pay its dividend over time. So intrinsic value is grossly important long term. Intrinsic value and fundamental analysis is terrible for short-term market. And again, everybody's short-term now. Everybody just worries about what the market's going to do today or tomorrow. They're not really looking to buy and invest and hold for 10 years a position. The average hold time for stocks these days is about 4 months. So fundamentals pay absolutely no flavor to that type of trading mentality. But that's what we've done to the markets, right? We've set unrealistic expectations on a lot of levels. But this was an interesting position because, and again, John, you're the one working on this case right now. But, when you're looking to produce an income of $250,000 a year, and you're looking at a low interest rate environment, which we are going to be in. And again, this is the important factor right now, is everybody's wrapped up into 5% money market yields we've had over the last couple of years. That's an anomaly now. That's not new. Right. I remember back in 1999, CDs were paying 8%. Bank CDs were paying 8% in 1999. Could not sell somebody on buying an 8% CD because the markets were cranking out 15% a year. Right? Now, everybody in the chat and driving right now, hold your hand up if you would like a bank CD for 8%. Right? Everybody.
Stay on the road.
That'd be great.
Don't veer off.
They don't exist anymore. They never will again. These money market rates that we're getting right now, which has produced a lot of extra income for families and households, are going away. And they're going to start going away in September. So the topic of building long-term dividend yielding, income producing portfolios is going to be exceedingly challenging over the next 20 years because of where dividends and where interest rates are headed and will be long term because of basic economics. So again, this is going to be one of the and again, creating a portfolio that can generate $250,000 a year, super easy, really easy. It just depends on how much capital you have to work with.
Yeah, and what rates are at the time.
Well, no, that doesn't regardless of the rate. Right?
Okay.
Let's say I need $250,000 a year in my portfolio, and the average yield on everything is 1%. I just got to have a $5 million portfolio, right? It's all about principal balance when you start creating yield.
Well, it's about principal balance, and usually there's a caveat in there where folks say, "Hey, this is the amount of income that I want, but I don't want to dip into my principal or touch my principal.
Oh, no,
I want that to be self-sustaining."
Right. So we're not even talking about inflation yet.
Yeah.
Yeah.
Mm-hmm.
Yeah.
And let's not. And so this is a great question that was posed to me around, hey, I'm young, I'm a high income earner right now, and the assets that this younger individual has to invest, it's kind of split. So there's money in a traditional IRA. Let's say, $200,000 in a traditional IRA. They've already put some money in a Roth. Great job. $100,000 in a Roth. And the rest is all sitting in a taxable, like a cash account. And the questions are, what can I do to position this money so that way in 20 or 25 years, I can just pull, $250,000 off this without losing any sleep.
But so two big factors come off of this, right? And I just did this. I wrote a report about this sometime back. And I'll have to look. It's still on the website. But the title of the report was $1 million Ain't What It Used to Be.
Yeah.
Right. And, back in 1980, it was super simple. Right. I buy a treasury at 14% interest and, I slap $1 million in it. I'm getting, $140,000 a year. Easy. Right. That's easy math. That's not the case anymore. But the problem is that $1 million back in 1980, you were doing great. $1 million today, not so much.
And so this is the problem with all of this analysis that we rope ourselves into. Yeah, $250,000 a year sounds great today, right? If I could, if I had $250,000 a year, I could live my life exactly the way I want today, no problem. The problem is that in 25 years, $250,000 is going to basically be equivalent to $100,000 today.
Yeah.
So it's not really, the answer really isn't in 20, 25 years, $250,000 is not going to do the job. We have to inflation adjust that $250,000 and then say, okay, if in 20, 25 years from now, if interest rates are, 2% and dividend yields are 2% and, inflation is running at 2%, et cetera, how much money do you need in the bank? Because again, as I said earlier, it all comes back down to principal value.
It does. And so some thoughts that came to my mind first and foremost, and the question was kind of posed to me of, hey, John, what would you do perhaps in the next, 30, 60, 90 days to kind of get things set up? What's kind of an initial plan of action here to get things started? And before really, and looking at the layout of how the accounts are structured right now, some money in a rollover IRA, some money in a Roth, some in an after-tax account. There's an after-tax bucket with a sizable balance in there. If it were me, sorry, I'm going to break in a little bit of financial planning here, Lance. Just put up with me for just a moment. That the money that's in the rollover IRA, that $200,000 in the rollover IRA, I would get that in the Roth right now. Pay the tax now. Get it done. Get all that money into that Roth IRA environment. So now that money, let's call it $300,000, that could be in a Roth IRA, that's all going to grow tax-free for the next 20, 25 years. And you can do that conversion because you've got the cash in the after-tax account where you can pay the tax liability on that. Mm-hmm. So rip the Band-Aid off, pay the tax, whether you spread it out $100,000 this year and you convert $100,000 next year. But if it were me, I would get the money in that Roth IRA as soon as possible. And now let's let that money get to work, right? Because you do have to think about inflation. And this particular individual mentioned that, hey, I'm pretty young right now. So you know what, John? I'm not concerned, at least right now. Social Security and Medicare isn't on the radar screen for me yet. But it will be.
That's an interesting topic, right? Though. And something that this, my personal attitude is that in my own financial planning, I never count on Social Security and Medicare. For me, that's gravy. If I get it, great. If I don't get it, I don't want to be reliant on it. We take a look at how many 80% of Americans are absolutely 100% reliant on Social Security and Medicare to retire. And if I'm in this gentleman's position, I'd be saying, exclude all that. I don't even want to look at it. If I get it, it's great. It's going to help pay my taxes, right?
Sure. Yeah. Yeah, but you got to think about it a little bit. Sure. Because at the end of the day, now if Social Security, will Social Security be there for me too? I'm not sure. It probably will be, but maybe, and who knows? Maybe
as old as you are, they'll be doing great.
Wow, that's brutal. Hey, well, I will say my kids do think I'm a dinosaur, but I still think I'm young.
But as Mike said, you're not relevant.
That's it. I'm not relevant, right? So maybe my full retirement age gets pushed out a little bit. Hint, my full retirement age is 67 years young. I'll be there in about 17 years. So, but you got to think about this stuff because, if Social Security goes away, I will tell you, you want to see a riot in the streets, that's what's going to happen.
Yeah, absolutely.
Right?
Absolutely. But, but look, this is, this is a great question. Look, and this is this is where everybody starts on their financial planning journey. It's the most basic question. It's and these are all the wrong questions for the most part. You can ignore inflation if you want, if that makes calculation. Look, it's easy math. You pick an interest rate that you want to use and call it dividends, you can call it interest income, you can call it whatever you want. And you can back into the math of what it takes to generate $250,000 a year in income, right? It's just a function. It's easy math. But the reality is that your lifestyle is going to change over 25 years. The cost of living is going to dramatically change over the next 25 years, as it has in the past. And the needs that you think you have today or will have in the future are going to be dramatically different. So that's the real problem, and this is the talent that John has and Richard has and Danny has for financial planning, is to look at those variables and say, look, this is very basic, but this is what you got to be looking at in the future. And it's going to be vastly different than what you probably think it is today. Be right back after the break. We'll wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Look, when it comes into financial planning, everybody does it different. Everybody's got different views. Everybody has different outlooks. Everybody has different expectations. And there is no right way or wrong way to do financial planning, because here's the dirty secret about financial planning. It's all a big guess. And this is why most people approach financial planning wrong, which is they go to a financial advisor or they go to some firm, right, wherever it is, and they run a financial plan for you. It's free, right? So they run you a free financial plan. And that's the hook to get you to move money over, right? And then you get this nice little binder with this whole financial plan in it. And you go home and you throw it in a drawer, you stick it up on a shelf, and then it's never looked at again. And then you wonder why in 15 or 20 years, it didn't work out the way you thought it was going to work out, right? Because you had a plan, but things changed. And the outcome was very different. And this is why what's very important and the way that we approach, planning here at RIA Advisors, which is that's just the initial step. Every year you're reviewing and updating that plan for changes. And so just like any plan or any roadmap, you have to regularly revisit that plan on a regular basis, whether it's twice a year, once a year, however often you want to do it. That's up to you. But you've got to revisit that plan and always be realistic about it and saying, look, we didn't, I said, that I was going to save, $25,000 last year, and I didn't do that. So you got to adjust the plan because you didn't meet your goal. And again, this is the important factor about your relationship with a financial advisor is that you have responsibilities just like the financial advisor does. As individuals, we tend to try to push off all the blame on the financial advisor. Well, my performance wasn't as good as the market was last year, or I didn't get to my goal last year. It's all the advisor's fault. Generally, there's blame to be shared.
You spent too much. You didn't save enough. You didn't meet your responsibilities. And in the relationship with a financial advisor, it is a two-party relationship. It is a relationship. You have responsibilities. You agreed to do certain things, cut your budget, save more money, invest regularly, whatever it was. Did you or did you not do that? And yes, the financial advisor also has responsibility, performance, asset protection, his job, right? And ensuring that the capital is doing what you both agreed it was supposed to do originally. But this is also where you can't go back and start changing your mind about things. When you met with your financial advisor, you said, hey, look, I just want 5% a year. So you build a portfolio that generates 5% a year. And then the market goes up 10%. You're going, well, why didn't I make more money? So now I'm upset. I'm going to go move my money somewhere else because I didn't get as much. But you told the advisor that you only wanted X. So you built a portfolio for X, but then you changed your mind, but you didn't inform your advisor that you changed your mind. So this relationship is key to and this is a relationship that is key to your long-term success of where you're going to be. And this is why most people don't reach their financial goals, because they don't have a plan, or if they do have a plan, they don't revisit it regularly and rebuild it and restructure it and manage it for actions by both parties. So you go to your financial advisor after the first year and the portfolio was supposed to generate 6, it only produced 5. That's on the financial advisor. And you go to the financial advisor and say, hey, we underperformed last year. What do we need to do different this year? And so you work with your advisor and say, okay, look, we're going to have to restructure the portfolio a bit to get that 1% back that we need next year. I didn't save enough. I took out more money than I said I was going to. Those are your responsibilities. And that also factors into the performance. I can't tell you how many people I've talked to where they say, well, my portfolio underperformed the market last year. And I'd start digging through the numbers and it's like, well, yeah, because your portfolio actually returned above market rates of return, but you took out a huge chunk of money last year, which impacts the return of your portfolio. If you're withdrawing principal, that's going to impact your total return. So it's a two-party relationship. And so if you're doing it on your own, do your financial planning, revisit it every year, build a plan, build a structure. There's all kinds of tools online. You can do it yourself. Or if you're working with a financial advisor, do the same thing, but revisit that on a regular basis. I'm sorry, John, go ahead.
No, I mean, amen to that right there. I wish I could tape record that and just play that over and over again because you're spot on.
We did record it.
Oh, good. Well, good. Then we can just play this on a loop. That's great. Man, am I spoiled. This is fantastic. So, but you're right. The whole approach with planning or the relationship that, the advisor has with the client or with the family, it's got to be collaborative. You got to have open discussions and open conversations around this. And both parties have responsibilities in the relationship. And you're right. In looking at financial planning, what are we really trying to do? We're trying to predict the future. I mean, that's what we're trying to do. And it is the unknown. But at least let's get a sense of where you are right now and where do you want to go. And let's put some realistic forward-looking assumptions together to make sure that we can keep you on the path, or help you from falling into the ditches on each side of the road. Let's help you stay on that right path to get you where you need to be. And so just like Lance is always talking about how the approach to investment management needs to be fluid, right? Taking profits along the way, raising cash, managing risk, controlling your exposure to the market. The approach to your financial plan needs to be fluid too, because you're right. So many times a financial plan is, hey, here's this binder. Hey, it's got a lot of pretty charts and graphs in it. And what do? You go stick it on your shelf, or it becomes a really nice coffee coaster sitting on your desk at home. Financial plans are meant to be revisited as things change in your life. That doesn't mean you need to be in there every day, nickel and diming it, right? But, every 6 months, at least once a year, or when there's a major life event, there's a change in your life, or there's or you're aware of a major change that's coming, that is the perfect time to revisit the plan and make sure you're having an open, collaborative discussion with your advisor. So Lance, you're talking about performance. So many times there are conversations I have with clients where, we have certain, goals and expenses kind of mapped out in their plan as far as what they want to spend and when. Well, there are times where, I've got to kind of be the voice of reason where the client says, hey, John, that backyard patio, I want to redo that. And the bid on that's going to be $80,000. I'm like, well, hold on a second. Do you think right now is the right time for you to do that? Do you think are we really going to spend $80,000 on that when we thought maybe we could do this for, let's say, 25 or 30 or a much lesser number? Let's talk about this and just see if this really makes sense, right? So you got to have those open conversations and be collaborative as part of the overall relationship that you have with a client, right?
Yeah. And again, this is, stuff that we talk about a lot. And I'm sorry to digress. It was just a kind of a topic that, we get into when we're talking about financial planning, but we often, dismiss the variability in returns. And, things change over time. And this goes back to the dividend, idea and creating income streams. The things that we talk about today, the things I want today are going to change. In 20 to 25 years is a long time. Somebody said in the chat that I'll be dribbling in 25 years. And yeah, that's true because I'll be 85. And if I'm still here, something has gone horribly wrong.
Yeah, I'm dribbling, but it's not a basketball.
Exactly.
I'm dribbling into my oatmeal.
The goal is things are going to change. In 20, 25 years, a lot of things are going to change. Marriage, divorce, kids, their weddings, their divorces, colleges, and all these things are going to impact future outcomes, and our tastes are going to change, our desires, our wants are going to change. But also inflation is going to change. Inflation will go up every year. It's been going up for 130 years. It's going to keep going up for the next 130 years because that's just the way inflation works over time. And again, the goal of the Fed is to get 2% inflation every year. So everything will go up every year at 2% if the Fed gets their wish. It's never that stagnant, but you get the idea. Things will cost more. So we have to start thinking about what our cost of living is going to be 25 years from now. And also factor in things like, is my house paid for?
Yeah.
Do I have other retirement benefits? Did I change careers and I picked up a pension? I can't tell you how many people that I meet with and they have a solid pension from whatever company they work for. It's like, I can live off my pension and I have this other money, right? Just kind of a side thought. So, but those things change. Maybe you didn't have a pension now, but you change jobs and you get a company with a pension. Pensions, are a great thing. I just had a friend of mine go to work for a police department. Now he's got access to a 457, 401k drop plan. There's all these benefits that he didn't have before. It's going to change the outlook. But those are all the things you have to consider in that financial plan. And, we haven't even talked about, and probably have to spend a day on this, but at some point, but where do you start factoring in insurance, life insurance, annuities, those type of things into factoring in and planning for that guaranteed income stream and retirement? Those are all factors.
Well, then as you're growing this wealth, right, and you're accumulating what I like to say dollars of critical mass, these dollars of critical mass, well, then how do you keep it? Liability protection, estate planning. Do you live in a high probate state? What about trust planning? So many other areas. Do you own real estate?
Yeah.
Are you protecting yourself? LLCs, what have you? Keep that money in your pocket.
Exactly.
Right?
Personally, I just bury everything in cans in the backyard.
Yeah, you just use a metal detector to find it, or do you have little flags up there?
And then I have my shotgun. I'm on the porch. Get off my lawn. I'm telling you, get off my lawn for a reason, because you're on my money.
That is the financial plan right there.
There you go. Get off my money. It's not my lawn. Get off my money. John, thank you.
Thank you.
All right, wrap up the show for the day. We'll be back tomorrow with Danny Ratliff, of course, as always. And then, of course, Thursday with Michael Leibowitz. We'll talk about the CPI number. All right, have a great day. See you back here tomorrow. Get by the website. The latest article on the 3 bullish and bearish takes on the markets on the website now, realinvestmentadvice.com. Go battle your personal confirmation bias. Read that article. I'd appreciate it. And be sure to like and subscribe to the show. That helps us out as well. All right, have a great day. We'll see you back here tomorrow.